Once again, welcome, ladies and gentlemen. Like Mr. Swa indicated, this is Gambia Finance Leaders Forum, where we aim to support young people in the country to develop them. And it's being sponsored by IG Business and Finance, a platform that offers training and development to young accountants. Today, our discussions is focusing on controls, more especially in governance. Many of us may have come across with governance or controls across our job. Governance, in a literal way, it is how an organization operates. When two or more people come together, they always have an objective, and they have to get some guidelines that enable them to achieve that purpose while they are set up in first place. However, in ensuring that that organization do what they are expected to do, there are different sources of that governance. One of them can be what government expect them to do. Like in the case of a company, you are supposed to follow the company law, you are supposed to pay your tax. When you are not doing that, definitely that means that there is a control failure. Similarly, the society itself also expects us to do something. If you operate in a society, we are supposed to contribute towards economics, environmental, and social impact of that society. We are not supposed to destroy. This is where sustainability comes in, the triple bottom line reporting comes in. You can't achieve this purpose and objective if you do not have controls in place as an organization. And that's why in a bigger institution, you have people responsible for controls, whether it's the internal policies, whether it is the financial controls, whether it is the compliance to the government regulations or other international regulations, as it may be, depending on your situations. That is why today, we at the Gambia Finance Leaders Forum decided to bring quite a number of professionals across who are all Gambians to discuss about controls. Major failures, in the case of Aaron, you may have had loss in banks, or maybe the case of Barings, all these were control failures. So we have three gentlemen. Unfortunately, we believe in diversity, but we couldn't get the female candidate or female panelists we had discussions with. They dropped out towards the end of the program. So we had to go with only the male candidates so that we can understand that. So let me introduce our panelists that will be sharing their knowledge, experience with us this evening. So first we have here is our brother, Mr. Bakary Sanneh. Bakary is a chartered accountant. You can see he has various professionals, both ACCA, CPA, and CGA. CPA, which is the Certified Public Accountant, and the CGA, I think that should be Certified General Accountant or something. But he's a chartered accountant with strong experience in audits and assurance. Bakary currently works as an audit and assurance manager with one of the leading and the largest regional firm in Washington State in America. That tells you that Bakary is calling all the way from the United States, and it's morning time. We are sorry, Bakary, but we appreciate for spending your early morning with us and to share your knowledge with us as well. He is the founder of Change PS Gambia, and previously Bakary has worked in BDO USA. He also worked with KPMG Sierra Leone, Deloitte Gambia, where he has audited banks, corporate, and international organizations. So you can see that he has quite a large experience from Gambia to West Africa and today in the USA. Welcome, Mr. Sanneh, to this forum. Next, we have Mr. Modou Ceesay. Modou Ceesay is also a chartered accountant and a certified internal auditor, a person with a strong and well experience. I mean, we appreciate everybody on this call, but Mr. Ceesay, truly, we've been trying on several occasions to bring officials who are working in the government to share our views in a different way. For the first time, we have Mr. Ceesay sacrificing and agreeing to come and speak in this platform. He is a frequent speaker locally and internationally on the areas of internal audit, governance, and enterprise risk management. He is the current Director General of Internal Audit at the Ministry of Finance and Economic Affairs of the Republic of Gambia. He has previously worked in the Accountant General's Department and also in the oil and gas industry in the Gambia. So he too has an experience both in private sector as well as government. And what is interesting, he has worked in Accountant General, now is in the Auditors Department. So he has seen both sides of what we are going to talk about this evening. Last but not the least is the man I call the African Auditor. Why I call him African Auditor, Alpha has traveled to so many countries in Africa in the process of auditing and reviewing institutions for EcoBank. He currently works as the head of internal audits in EcoBank. Of course, he's a fellow of ACCA and a certified risk-based auditor. He has worked across various areas. So if Alpha is auditing you, then you can't hide anything. He has worked in finance. He has worked in human resources manager as head of human resources. He has been an internal auditor up till now, but he has also served as an external auditor previously with Deloitte. So he has seen both sides. And he has experience, like I said, across EcoBank group, in the countries we can't name it here, or else we will focus the whole thing on Alpha. But again, he too has worked in Deloitte and National Audit Office. Interestingly, if you look at among these three panelists, Bakary has worked in Deloitte, Alpha has worked in Deloitte, Mr. Ceesay has worked in government, Auditor General Department, and Alpha has also worked in there. So it's a mix of experienced professionals who have done audit from private sector, public sector, internal audit, external audit, and other functions of the business. And welcome, Mr. Ceesay and Mr. Jallow.
Thank you.
So welcome once again, gentlemen. Today is going to be an interesting forum. And I want to start with Mr. Jallow, Alpha. Organizations build internal control functions. And for some people who does not understand why internal controls is very important, they may probably be thinking that is stopping business, like I've had in some instance, or is delaying transactions. From your experience as an internal auditor, financial controller, HR manager, why do you think internal control, let me start with that, is important for an organization? Mr. Jallow.
Thank you, Mr. Sawaneh. Thank you very much for inviting me to this forum. Yes, controls, importance of controls in businesses. To start with first, what we should understand is anytime we open a business, it means there are risks. So for business, it means they have an objective. To attain those objectives, there are processes that they will follow. And those processes usually, if you don't embed controls within them, usually you are planning to fail. So what we can say as the importance of internal controls is to make sure that you achieve your objectives. By achieving your objectives, it means you have to address the risks that your business is facing. So to do that, we have to include bring in controls. So those controls, that's what they are trying to mitigate here. Controls are introduced so that you can mitigate those risks. Now, the risks here we are talking about, the moment, as you rightly said when you started in the introduction, companies usually, if you open it, means you have to comply with the Companies Act. No company in any country should start business when you don't want to comply with the Companies Act of that particular place. Also, for example, you have processes. Within the institution itself, you have processes, and all those processes should be backed by SOMs. I call it standard operating manuals. So these are processes that should be followed so that when you want to execute, for example, a transaction, these are the steps you should follow. And the importance of that is to make sure we attain our objective by ensuring that operational losses are not happening. We don't have reputation because, for example, I'm coming from the banking industry. Reputation is a key issue, a key risk that we don't want to entertain. That one, there's zero tolerance on reputation. Regulatory issues, CBG, as a banker, usually you will make sure that you are complying with Central Bank Act, because if not, your license is at risk. So to do that, we have to come up with controls. Those controls are to help us attain our objectives by ensuring that we don't have risk which will stop us from obtaining or achieving our objectives. So the key issue here is importance of risk cannot be, importance of controls cannot be overemphasized. So controls are, one can say, the responsibility of everybody, but mainly by management and the board. So for me, controls is the key. If you want your business to succeed, any successful or profitable business, it means that particular business must have strong controls. You cannot be profitable when you have no strong controls, because obviously, if it is controls, you don't have proper controls, even though you are profitable at a particular period, you may come back and vomit those things. Operational losses will come, you have to come back. For example, in a bank, if you don't have controls in terms of the way you give out credits, there'll be a problem. So those things will haunt you, and your aim of achieving profit or even sustaining your business cannot happen. So obviously controls are very important, and it is the responsibility of everybody. I think that's sort of a summary of what I understand in terms of controls. Thank you.
Thank you very much, Alpha. That's well detailed, and I get a lot of information from that. But the key message out there is, you form an organization, you have an objective. In moving towards achieving that objective, there could be some challenges that will prevent you from achieving the objective. So what Alpha is literally telling us, that anything we do to manage that objective, for us to move towards achieving that, is part of our controls. It may be process, it may be looking at reputations, depends on the sector where you are working at. You may be making money. If you don't put controls, you're losing it on the other side. This reminds me of one of our colleagues then in EcoBank, Justice Kobina, a Ghanaian who used to say, you don't want to dig a hole to cover a hole. In other words, you don't want to make money when you're going to lose money on the other side there. So it's very important for organizations to look at that when you are building your processes. And I think from that, I want to move to Mr. Ceesay. Like I said earlier, all of these panelists are representing themselves. Nobody's representing their employers here. But I want to ask a question, since Mr. Ceesay is the most active person in government. I know, Mr. Ceesay, government is the biggest stakeholder in any country. They spend more than any other institutions in any country. And Mr. Jallow spoke about the fact that for companies, you have a Company Act that tells you what you need to do at minimum. I want to understand, from government point of view, how do you put controls in your decision making to ensure you are meeting the objective of the stakeholders, which are the taxpayers and the citizens? Mr. Ceesay.
All right, thank you very much, Mr. Sawaneh. And thank you very much, previous speakers, Alpha. I think it has been a very important session to talk about controls, and controls, of course, transcends boundaries in terms of public and private sector. Like the whole idea in your introduction and also in Alpha's statement, it has been mentioned about the need for achieving objectives. When entities set their own objectives, to achieve those objectives, there are risks or potential risks that will avert them, and they need to put in place things that will help them to avert or to ease attainment of those objectives. And that is where the controls elements comes in, the systems of controls that will help them to at least achieve the objectives in the short and longer term, and also to maintain that environment of achieving. And likewise, government also, it's having the similar objectives. Government have service delivery objectives that are set out in their national development plans, as you wish to call them, or in strategic documents of ministries, departments, and agencies. And likewise, they also need to identify and set part and parcel of those systems, financial systems in place, administrative systems in place, and also financial controls in place, administrative IT systems, so that it will ease attainment of the relevant sector service delivery objectives. And this is really, really very important for attainment of objectives. Controls, like Alpha has just emphasized, it is what will let you, as an organization, be it the public or the private sector, to help you remove the obstacles that will stop you from achieving your objectives. So the public sector, likewise, equally, it is very important, and its control decisions are made in terms of every objective that you set. But the government, of course, has established a lot of government in general, not the government in particular here, but governments in general have established a lot of policies, procedures, a lot of laws, a lot of acts, a lot of regulations that will help particular entities, particular departments, particular ministries from achieving their given objectives. And those are the systems of controls in place in government, for example. And those decisions definitely are well thought of in every government objective settings. So I think, in short, that may summarily answer some of the, partly answer the question that you will put forward, Mr. Sawaneh. If you have, if somebody has an additional thing, maybe you can put forward.
All right. Yeah, thank you very much, Mr. Ceesay. And I think that's very enlightening, telling us that what government also do, they also have an objective, and this is important for the larger stakeholders, knowing that government also have some controls at their level where they put procedures and processes that enable them to achieve that objective, and they have guidelines like National Development Plan, which is similar to the strategy plan of a company. I will move to Mr. Sanneh. Mr. Sanneh, I know that one of the most important or talk about report that came out about internal control is a framework called the COSO report that was led by Tradeway Commission. And in that report, one of the key elements of controls, a control framework, is the environment. Environment here refers to the structure, the process. But in any organization, particularly within the organization, the environment cannot be made without the leadership. The leadership creates a culture. From your experience, to what extent do you think the leadership style of the senior management influence the kind of controls that happen in that organization? Mr. Sanneh.
Thank you, Ebrima. That's a very deep question. And I first want to acknowledge the presence of my colleagues and everyone on the call. But before getting to your question, I just wanted to piggyback from what both Alpha and Modou has said about importance of controls. And I want to focus on mainly examples, real life examples, to kind of elaborate the point. I had a client who had a CFO, and what the CFO was doing in terms of fraud and also kind of working around the controls. Like when he was doing payroll on a monthly basis, he has an Excel spreadsheet. And on this Excel spreadsheet, he has the names of all the staffs, including himself, and the amount of their payroll. And this, once he finishes this, he doesn't total it. He takes it like that to the GM to sign. Once the GM signs, he goes back, adds his name again, or add another number to his payroll amount, then total it and go to the bank and cash it. So the failure of the control here is the GM is signing a payroll register that doesn't have a total, and the CFO has the luxury to go back, add another number there and cash an amount that is higher than what the GM would have approved if everything was just based on just the normal staff size that they have. So you see, when a control fails, what happens if it is an organization that is profit making, the first thing that it does, it breaks that objective. So the objective of making profits kind of goes down the drain. Because what happened, your profit margins go down because somebody is defrauding the organization. If it is, for example, a government or an efficiency audit, like in the United States, we have different types of audits. You have performance audits, you have financial statement audits. Performance audits are mainly what Modou and his team essentially does. You look at a government. What is the main objective of a government? It's providing service, making things easy for the population. So that objective, when you go into audit, is you look at the efficiency of how they're able to achieve that objective. Are they able to distribute funds equally amongst the population for everybody to benefit? It's somebody sitting up there that is kind of benefiting from that funds, that it doesn't reach the end consumer. But now going back to your question about the COSO framework and mainly the control environment. See, the failures that you have seen, corporate failures that you have seen over the period, are mostly corporate failures. And the most dangerous corporate failure is when it is at the top. That is the senior management, because they have all the controls in their fist. Now, when they let loose, what happens is now it opens a whole door that nobody can close because the box stops at them. When you look at Enron, why did the company fail? It was the top senior executives that were defrauding the company. They had loans that they were not reporting in the company's books because they had created shell companies that were reporting those loans. So when you look at their balance sheet, it was very small, but essentially they have off-balance sheet loans that were not reported. So basically what that was doing was it was inflating their profits in their books when actually the cash wasn't there, right? If you look at a company like a German company that was making payments, this company had $2 million excess cash in their books that wasn't available, right? So essentially what they were doing, they overflated or they inflated their balance sheet by $2 million. So when you look at their balance sheet, you said, oh, this company is liquid, they have cash, their balance sheet side is good. But basically this is, a failed company. They are showing numbers that do not exist in real terms. So that's why it's very important for the top executive of any company, whether it is a government, to be people of integrity, people of principles, and people of moral values, so that they wouldn't use their positions in order to defraud the company. And that's why when we as auditors go to audit a company, one of the things that you look at is the control environment. And what does the control environment look at? It looks at the integrity of management. So we probably may do background checks on some of the management, senior management staff, the CEO and the CFO. Are they people who are known of fraud? Are they people who have integrity issues? If they have that, then our risk volume or risk value goes up because we are dealing with people that we cannot trust. So it means we increase our professional skepticism to such an extent that we would be able to perhaps maybe find out some of the control lapses or weaknesses that are going on. But that's a very difficult issue to deal with because they can cover their tracks.
Thank you very much, Mr. Sanneh. That's very clear and deep. And the examples, I can connect with that example because I was reading another case of a situation where somebody was depositing money in the bank on behalf of the company. It's a small business and they have only one accountant assistant. And this guy was depositing money in the bank, also bring the receipts. So apparently when he goes to the bank, he got 2 receipts from the bank. One of them, he will fill it properly with the money they gave him and bring that one back to the office, but without the bank stamp. The other one, he will just basically change the money from there and tear that into pieces. But because the people he was reporting to don't understand all these controls, when they see a bank slip, they don't even know it needs a stamp and they don't do anything. He reconciled the account. They never knew that was fraud happening in their account until they want somebody else to come and invest in their company. When those people send auditors to come and do a due diligence on their financial statements, they realize that they don't have enough money in the bank like they claim to have. So it's very important for senior management, those responsible, to understand this basic. Look at just not having a total. That is a major failure. Not having a total of an amount you are assigned. This is very critical. And I will go to Mr. Jallow from where Bakary talks about, because he spoke about the senior management. But when you come to the real work, who are on the ground, the foot soldiers are junior staff in most cases. And a gentleman called Nick Leeson, who brought down Baring Bank in Singapore, UK. The Baring Bank had a branch in Singapore, but the headquarters was in the UK. And Nick Leeson was a dealer in derivatives. He was hiding things. When he was interviewed at the CMI, one of the things he said was that he used to bully people, basically. He was a senior staff in the treasury. You have junior staff handling or controlling him. Mr. Jallow, how important it is to empower people who are in charge of controls and compliance in an organization?
Thank you for that question. As you rightly said, people at the top matters a lot. But as you rightly also said, the people on the foot soldiers are actually the people who usually transact, who usually process those transactions. For example, I'm taking an example. It's not actually a live example. I'm just giving a scenario. For example, if I am as an auditor, the head of audit, for example, Ecobank Gambia, if I should go to a teller or even back office officer and ask them to credit my account from anywhere, if at all they can do that without asking questions, for me, it means they are not empowered. So what is important is and usually this is how I communicate to people, especially those people who process. You are the MD and the director at your desk. You are responsible. No one can come and bully you here. This is my language. So for me, what is important, yes, the bosses are there, but you at your level, you should make sure anything that you are associating yourself with is within the rules. Play within the rules. I know, as you rightly said, what the example where the treasurer or somebody is the boss and is bullying them. Those things should be brought out through whether we are going to have whistleblowing in a situation, because you must have a friend who you can confide to and explain that this is what I'm feeling from somewhere. What you need to do is you need to have at least one person who you trust and you can explain. And you should be bold enough sometimes to bring these things out. But I know your job is at risk because you are thinking, if I should do this, maybe I will lose my job. So it is difficult, but I think what is important is to have management or the heads who are their integrity is not questionable. As Bakary rightly said, if you are auditing a place and you see that the management or the heads are not quite some people who you are willing to do business with, or you can take their words, then it means you need to do a proper digging when you are auditing. So that will affect your sample size and so on. But what is important is know the rules. Let every individual, whether it's a junior staff or a senior staff, you should know the policies of the businesses that you are working, because through that you will be able to guide yourself. And you seek advice. Make noise. Talk to people who are junior, who you think can influence those people as well. Because it's a corporate world, a corporate setup, it means everything should be transparent. So if you are seeing somebody is using because of their position and they're coming and bullying you, you should make noise. You should not sit on those things, and we should not tolerate that anywhere. Thank you.
Thank you very much, Alpha. And it's important. I always also encourage young people on this direction. It's important you make noise. Sometimes life, it is very difficult, but we are responsible 100% for ourselves. And in some instances, you may have to exit that organization. You don't have to keep there because you are building a career, you are building a value. You want, in 30 years' time, when your grandkids are looking at the internet, they'll be able to say, yes, this is our grandfather, our grandmother, and he has achieved that. Now, on the internet, if you search things that happened in 1998, they are on the net. And whatever goes in the net, it never comes out again, no matter, even if you delete it. So it's important we look at our values, our purpose, and when our values are not connecting with what organizations are doing, you either exit, make noise if the platform exists, we should blow if the platform exists, but it's important you take personal responsibility for that. Mr. Ceesay, independence is very important for the audit profession. External auditors are expected to be independent of the management and the board. Internal auditors also are expected to be independent. But the challenge is always for the internal auditor, because they are part of the management in some extent. They are within the same office, their salaries are paid from the same office, unlike an external auditor. How do one balance independence when you still want to work with management to be a service provider?
Thank you very much, Mr. Sawaneh. I think that's a very, very important and a very challenging question professionally. I know currently, even at the professional level of the internal audit, there is a debate as to where do we stop in value addition versus independence. How does internal auditors add value to the organizations as a consultant or as an inside consultant, versus how do they maintain their independence in the as an audit function? Definitely this is a very important thing, but independence to an audit is absolutely necessary. But I think that can be done. There are guidelines that have been put forward as to how the internal auditor tries to maintain a balance between independence and value addition. I mean, there is also an encouragement of the internal auditor's role into taking up most of the consulting or advisory services, which sometimes may compromise their independence, but seemingly they could still be guided. As the internal auditor there, independent safeguards are on board by the standards. For example, the standards of internal auditor will advise that the audit functions avoids taking decisions or making control decisions, making management decisions. You're always on board to advise. You need to come closer to management. Also, you need to understand the processes of the organization and also the processes, the business objectives that have been set in order to advise them. I mean, in order to advise, you really have to be closer to the forefront of issues where they are happening. But there need to be some safeguards that you put in place as to avoiding taking decisions that are primarily belong to the management. I mean, that's where the drawing of the curtain should be made between a value addition. For example, you take a risk management function, risk management. More practical examples, for example, internal audit can champion enterprise risk management, for example, in the organization, to bring awareness that, I mean, management need to really have a formal policy, formal structure in place in order to deal with risk, in order to have a systematic way of addressing it, a structured format of dealing, of assessing, of identifying, of giving task owners risk management. But where does internal audit stop in this? I mean, after championing it, if management come back and say, internal audit, I mean, you are the ones who have been the pioneers of the internal auditor will raise the flag to really be the decision makers, the person who set the risk appetite, for example, in the organization. That is management, because management is entrusted and have the accountability to report back on the objectives of the organization. So therefore, we just can champion and help coordinate or help sensitize and give you more awareness about risk management, report on the effectiveness of what management is doing, for example, but don't check the roles that management should play. So there is this dilemma of independence versus value addition. It is an ongoing debate, but really the profession is pushing towards internal auditors making really be more assertive in their consulting role and putting safeguards to avoid their independence being compromised. Thank you.
Yeah, thank you very much for that, Mr. Ceesay. Yeah, I've read something on that, because it's a big challenge to maintain independence, and at the same time, you want to add value to management, you want to participate, you want to advise them, and it's critical and important that you try to maintain that independence. Don't do what they are supposed to do. You can advise them, give them options, or ask them to come up with something. I will.
And just to mention, maybe if I'm not interrupting, just to add, I mean, there are safeguards about, how to really maintain the independence of the internal audit. For example, the reporting lines, the internal auditor has to be there, but the internal audit, in order to assure it's independent, it has a functional reporting to the highest level of the organization. And this preferable is the board, and that preferable is also the chairman of the audit committee of the board, for example, if there exists one. So those are issues of how you assure the independence. The reporting line is one of them. I mean, the funding aspect of one of them, the formal mandate, for example, giving them unrestricted access, also guaranteeing that the independence of the internal audit function, but then also bringing them on in terms of where they can add value to the organizations in terms of advisory roles is also very important. Thank you.
Thank you very much. Thank you. That's also very helpful in terms of who are they reporting to, and that's very critical. Mr. Sanneh, I know technology has been coming up previously in the past. When we talk about controls, it was manual works. You can see things physically, but there is a shift, and a major shift for that matter. Sometimes, personally, when I sit and look at our environment in Africa, most of the time, we are not ready. But we are bringing a lot of technologies, from simple online banking to AIs, blockchains are now coming up. And these new technologies comes with their own risk, which sometimes management implements them and controllers probably are not aware. Auditors probably are not aware. What is your take on this? Because I feel like there's a risk here, which we need to find a solution, or else you bring a technology which internal auditors don't even understand how to go through it, how to audit it properly. and they will think everything is okay until you find there's a big fraud from the technology.
Thank you, Ebrima. That's a good question also. Again, my colleagues have made great points. Just the only addition I wanted to make, I mean, I like giving practical examples because it makes you relate to the theories. If you look at the failure of Wells Fargo, I'm not sure how many of you are aware of the fraud that happened in Wells Fargo. Just like the question that Alpha answered, it was bottom up. It was not the top executives. It was the staff, the junior staff. But how did that happen? It was all because of the policies that management put in place. You have unreasonable revenue targets to achieve. And you say, okay, if you bring this much business, we give you this much commission. So what you're doing now, people want commission, right? They want incentives. So the staff were opening fraudulent accounts that never existed so that they can get their commission. The firm or the bank was reporting profits that never existed, right? So that's also the importance of not just limiting controls to the top executive, but this has to be a company-wide thing or a government-wide thing. Control is the business of everyone in the organization, not just these top senior executives. Now, coming to the question of how technology helps. Looking at the example that I gave, and I don't know how many of you are also familiar with the advancements in technology, especially accounting softwares. QuickBooks now have like what they call QuickBooks Online. It's a cloud-based accounting software that you don't need a desktop. You can work from anywhere in the world you are. You can all work at the same time. In that module, QuickBooks has what they call automated bank reconciliation. So your QuickBooks Online is automatically linked to your bank statement. So it basically downloads the transactions from your bank statement and posts it into QuickBooks, whether they are revenue or expense transactions. So what you as an individual, as a CFO or controller would eventually do is just to make sure that those transactions are actually posted to the right account. If not, some of them would post into kind of transitory accounts until you reconcile and they move to the final account. So what happens is if you have manual controls, like we said before, there are 4 objectives of internal controls, or controls generally. One is to safeguard the assets of the enterprise or the entity. Number 2 is to ensure management has reliable financial information. So if you look at the first one, to safeguard the assets of the entity, if you have controls that are automated and you remove the human element from there, both the person that is performing the control and the person that is reviewing it have little control in maneuvering or moving around the control because it's all automated. You prepare it, the reconciliation is done, it's balanced. If you don't balance it, the reconciliation is never going to close. If you are doing it manually, you can plug in numbers, you can do whatever you want to do because it's manual intervention. But once you automate it, you limit those kind of whether it is fraud or by mistake, you limit some of those kind of inherent risks that are associated with manual controls. So what happens now, the person that's also reviewing it also, when he or she is reviewing, there is little they can do. They review to ensure that 1, the reconciliation is correct. 2, the right variables are in there, and they sign off as reviewer. So for example, when us as auditors come in, when you say the controller prepares bank reconciliation and the CFO reviews them, when I'm testing your controls, I'm looking at evidence for the controller preparing the bank reconciliation and the CFO reviewing it, right? So that could be an automated process. Already you have signed off as preparer and the CFO signs off as reviewer of the control. So the evidence is there. But you can tell me that you have that control as long as there is no evidence for me to see that the controller is preparing it and the CFO is reviewing it. As far as I'm concerned, the control doesn't exist or it's not implemented. The design may be there, but it's not implemented. So you'll notice when you automate controls, obviously what it does, it ensures that management has reliable financial information, and that also helps them make timely and informed decisions. because what they're getting is actually accurate and it's timely. But when you eliminate that element from there and you just want to do manual, it's prone to human error, inherent risk of making mistakes and all that. And that's why it's very important that as the world is shifting, as transactions are becoming more and more, it's difficult to really control all these transactions manually. So we are forced to kind of go digital, to go automated, so that we can actually help organizations achieve their objectives, whether it's financial or whether it's efficiency.
Thank you very much, Bakary. So all the organizations that have started implementing technology, they can see the benefit of using technology to improve controls in their organizations. And I will go to Mr. Jallow. Controls is part of a bigger governance framework. And I know a number of mechanisms have been put in place, a lot of investments in technology. You've seen so many codes that are coming out just to ensure organizations are achieving or are to achieve their objective, to serve all the stakeholders positively. But still, we see every now and then, there are failures in controls. There are companies are going down, bankruptcy, or frauds are coming out. We know a lot of that is happening around, not only in Africa and in Europe. We've seen the recent case in Germany and other places. Why do you think controls are failing after all these investments and all these other mechanisms we put in place? Why is it that still now controls are failing us? We are not achieving what we want from these control processes.
Thank you very much for your question. As you rightly said, technology is a business enabler. What it does is to help us come up with process transactions or do things that in a short and with high volume of data. What as controllers, using technology, going back to Bakary's contribution, technology is used to enable, to improve controls. One, by using exception reporting. You can use a scenario where you use those things and it will help you. Let's go through behavioral analysis in terms of using transactions. For example, if you are looking at anti-money laundering issues. For example, people are using, especially, let me take Gambia as an example, is a cash economy where most of our transactions are done in cash. And the behavior of those transactions within accounts can give you a pattern that can dictate when, that can tell you something about the customer. So technology, it is only through technology that we can check those things. You cannot go into every transaction for the entire, for example, I'm taking an example of a bank where you go and check every transaction on a daily basis. What you do, you have to use technology. Manually, you cannot do that. But still, as you rightly said, we are having failures, even within with using technology. Part of it is maybe the design of the technology itself. The design of the technology, if it is not well designed, you don't do a proper UAT, that is user access tests, all those things, so that you come up with results before you sign them out. You sign them up for implementation, could be a problem. Sometimes also you need to have experts who will be checking those reports that are coming even from technology, because sometimes using our technology, still there are problems that can happen. So you need to have an expert, whether you need an IS auditor, for example, who will be reviewing those scripts. Are you getting the results that we expect from using those technology? Yes, we can have a mobile app. Is mobile app behaving the way we want it to behave? We want customers to have convenience at their places. Are we giving them, are we attaining those things? So to do that, it means we have to make sure that our platforms are available. So how do we ensure that these platforms are available? In the Gambia, for example, we know internet issue, network is an issue. We can have transactions that are, you start a transaction, all of a sudden, even at ATM, it stops. What we expect is for the system to return that money if at all you are not paid within a short period. And somebody should be there to review those things. These are examples of how we use technology in terms of improving controls. So yes, we're using technology, but still we have room for more improvement, especially in this part of the world. Thank you very much.
All right, thank you very much, Alpha. Good evening once for all. This is just to remind us we are on the Gambia Finance Leaders Forum, where we are talking about controls in governance. And today we have Mr. Bakary Sanneh with us, Modou Ceesay and Alpha Jallow, who are sharing their experience with us. This is Ebrima Sawaneh, your moderator for today's program. If you have any questions, you can please share it with us. We'll be having a question and answer session in another 5 minutes time. But for the meantime, I want to talk to Mr. Ceesay. Alpha spoke about we can have all the technologies, and he briefly gave us about the trainings, about the use of technology, which we still have the frauds, other things happening. My question, and which I believe sometimes happen, is that some of the controls also fail because people don't have the capacity. They don't understand what they are doing. They don't have the experience. It's as simple as you put a junior staff to be a judge. He won't probably give the right judgment. If you put a junior accountant to be taking care of a bigger company, doesn't have the qualification. But how do we develop capacity with the aim to ensure that we have controls in place? How is that important for organizations or even for government?
Thank you very much, Mr. Sawaneh. I think, yeah, that question transcends borders in terms of failures in controls. Obviously, that is why one of the reasons, like Mr. Bakary was saying, the need for review of those controls. There's a constant need to review if they are functioning. I mean, if they're effectively, and if they're functioning, how well are they functioning? Can they be enhanced? Can they be improved? This is where functions like the internal audit comes in, other functions like other reviews or other assurance providers comes in, a second line of defense assurance, for example, risk management and the like. Definitely, I think one of the elements that you mentioned is the element of manpower or resources, human resources in terms of control. It's also one of the control elements. I'm sure you would, we all agree that control activities, processes, and procedures, affected by the entity to achieve its objective. So one of those elements is the human resource, which also, needs to be assessed to be in a status that it can help achieve the organization's objective. In government, I think this is a very general problem. This is not particularly for one government or not, but this is very much in Africa. There's a general problem about capacity in government. The controls have failed even at the start. Remember the sequencing of the controls. For example, if you're supposed to hire the right individual, and the recruitment process was not done properly, the right person is not hired and given the right in the right job, therefore the control will fail. We see this even at very top levels in government, where probably at the level of vote controls, at the level of accounting officers, that the right mix of people are not given the right function. And therefore, that is the beginning of that's one of the elements of a control failure, because those environments, look at the board composition, for example. If the board is not composed of the right mixture, if the board is not composed of the right experience, the right knowledge, the skill sets that is needed to move a particular organization to the right direction, therefore, that's one of the control elements where they will fail, because that board, it will fail in exercising its oversight function, which is a very important control function that the board needs to exercise over the management. The board needs to exercise oversight over the management so that the management will be held accountable for their actions or the delegated responsibilities that are given to them by the board to run the organization on a day-to-day basis. Few of the examples that we've quoted, whether it happens at the level of the management, it is a kind of a fraud, or whether it happens at the level of the middle management in the organization, you can see the failures of oversight or the failures of reviews. This is why the constant failures of controls need to be at least observed, and those elements of capacity building are very important, and it brings in the issue of technology as well. I think the issue of technology also, Alpha has mentioned, it needs to be assessed. You also need to have the capacity to handle that technology before, some of these technologies are put in place. Even though I do agree that technology, like Bakary has mentioned, it is one of the critical elements of control, because technology, as many will say, is the first element of control. Automation is control. Many of the time, if we don't automate, we are losing track of the control objective or the control benefits that we may have in the control objectives. I hope that answers. Thank you.
All right, thank you very much. I mean, that is very helpful. In fact, this morning I was talking to a group of MBA students on corporate governance, and that's one of the key things we spoke about, how we recruit people at the board level. Do they have the relevant skills? Do they have the knowledge that they need to be able to carry out their functions? And this is sometimes a big mistake in many institutions. They want to set up a board just to tick a box that we have a board of directors. But the composition of that board is very, very important. Sometimes the board is not meeting as they require to be meeting. That's a controlled failure because you won't be able to carry out your oversight duties. Sometimes the board is meeting, but they don't know what they are looking at. They don't understand what the management is giving them. All they are looking after is the balance sheet and profit and loss. They don't probably if you look at the internal audit report. But I know that many organizations or boards, they don't know, but they rely on external auditors' report. Even though we know that clearly external auditor's job is not to see fraud or not, it's what they've observed. But I want to talk to an external auditor, in this case, Bakary. How do you assess effectiveness of a control for you to be able to communicate to the board what you have seen, to give them some confidence before you sign an account?
Great question, Ebrima. So as external auditors, I'll first maybe give you, not everybody here has a background of what we do. So when we typically go into an organization for an audit, there are steps that we follow. I mean, and each of those steps is actually helping you towards essentially giving the right opinion, audit opinion, right? So in terms of what we do for the controls, we first look at the what we call the COSO framework, which is essentially the 5 framework. You look at, for example, the control environment, and I've talked about that. Talks about the integrity of management, the board oversight, like Modou talked about. It also looks at things like, for example, control activities. Do you have the right processes and procedures in place to be able to mitigate against risk that the company is dealing with, whether it's financial statement risk or whether it's efficiency risk? It looks at things like, for example, risk management or risk assessment. Does the company has an established risk management framework where they kind of offload, they kind of look at risk before it happens? Like, most organizations are reactive and not proactive. So you look at overall organization-wide, what are some of the risks that we are dealing with? Like just yesterday, I was in a call with a client whose main business is people donate goods to them, whether it's clothing, whatever it is. They process those clothes and then they resell them. But because of COVID-19 and the situation, most of their stores right now are breaking even, but they are not able to contribute to the overall organization overhead or the mission. So at this point, they are assessing upfront, does it make sense to keep opening most of those stores? In fact, yes, they are breaking even, they're able to take care of their own cost, but what benefit are they bringing to the overall organization? So that's risk assessment right there. They are assessing financially, where does the company stand? Do we need to follow, or do we need to lay off some of our staff because we can't meet the cost? I mean, how, or do we need to draw from our investments in order to invest some of those funds into our business until at such time that the heydays would come? So that's risk assessment right there, right? So we look at whether the organization has something like that, that they identify risk, they assess the risk, they assess the likelihood of the risk happening, the frequency, and then also if it happens, or what position do we take? Do we avoid it? Do we embrace the risk and put in control? So all these things are important. The other thing that we also look at is there proper information and communication system within the entity? Like both Alpha and Modou said, is the technology the right technology for management? Is it giving us the right information? Do we have proper balance sheet and income statement information? Does it give us the information that management needs to make timely and informed decision? See, when your technology is wrong, you make wrong decisions because information you are getting in order to make those decisions is actually wrong. So you cannot actually make any informed and reliable decision on a data that is wrong, right? So we look at how that technology helps management in achieving that objective. Is the technology user-friendly? Is it producing the kind of reports that it needs to produce? And that's why for entities that kind of go through technology changes, there's what they call data conversion issues. So did you do a proper data conversion? Did your old system properly move from your old system to your new system? So all these are important things that we look at. We also, so that's high level that we look at. Once we are satisfied that all these things are in place, then that raises our confidence level, our assurance level on this organization. So we say, okay, the general environment is good and we are comfortable, so we can lower our scale. If I'm dealing with an organization like that and I go in there, if my professional skepticism is supposed to be 100%, I'll probably lower it to 50% because at least the top level there is good. Now, when I come down to the lower level now, what I'm looking at is for each of your balance sheet accounts that are material that I'm testing, like for example, cash. I want to make sure, I want to first look at what controls do you have over cash. Most organizations would say we do monthly bank reconciliations. My question is, who does the bank reconciliation? Who reviews the bank reconciliation? The controller does the reconciliation and the CFO reviews it. So I go down to testing. I will select one transaction, and that's because that's your design. So I need to test the implementation. So is that design really implemented? So I go and take 1 month bank reconciliation at random. I'm not going to tell you which month. And I don't know, for some of you that are auditors, I'll just throw this joke out there. Sometimes you audit an organization and you have a difference. For example, they give you their AR agent, it's different from the GL. And then let's say the difference is $100,000 and they'll ask you, what's your materiality level? And you'll be like, I mean, that's for me to know and not for you to know, right? But yeah, so we look at, is there evidence that the controller prepares the bank rec? And is there evidence that the CFO reviews it? If I go down and take 1 month and I see that evidence, then I know your design is implemented. So if I want to test controls for cash, again, there is a sampling procedure that you go through in terms of how much reconciliations that you want to test to see whether that control is actually implemented. Because the fact that the design is implemented doesn't mean the control actually existed. You can have the design implemented in 1 month, but for the rest of the year, there was no control. So essentially, that's a failure right there. You just implemented it 1 month. So those are some of the things that we are looking at. If you don't have any policy and procedure at all, I'm not going to waste my time to even test your controls because the design is not there. It's a complete failure. So I'll write a management report for you to say that you don't have controls established in order to help you achieve your organization objective. However, if these controls are there, then I move down to my substantive testing. Now, in terms of my substantive testing, I have assurance that your controls are working. So that's going to lower my sample size. If I was ordinarily going to test 100 transactions, with your controls working, that's going to lower my sample size to probably 10 or 25, right? So that's the benefit of having good controls. It actually reduces your audit burden because the auditors wouldn't ask more than ordinarily they should have asked.
Wow, thank you very much, Bakary. You have given us an excellent audit lectures in this short time. And I'm so many accountants, particularly the junior ones who are growing up, are very happy to hear this, how you go about picking or making decisions of how you test your controls, all the way from the environment, risk assessments, the communications, everything that you do there. And it's going to be very, very helpful for so many of them. Before I move to questions and answers, Mr. Jallow, I know today is your birthday. Happy birthday once again for joining us on this special day.
Yeah.
Yeah. So, Mr. Jallow, we know that controls are meant to influence our behavior, are meant to put us in a way that we're supposed to behave in certain directions. On the other hand, when you look at innovations, entrepreneurship, culture tend to be taking risk. They don't want to be controlled. And we need both sides. We need organizations that can think, innovate new solutions, new services for them to be able to grow. Because if you do the same thing in the past 10 years, you will not exist. like I know there's one time you put a quote, you yourself, Mr. Jallow, say that you have to grow. The only time you don't have to grow is when you are dead, you are inside, you are being buried. How do we balance pushing innovation and entrepreneurship in an organization, and at the same time we want to ensure there are proper controls within the same organization, because these are two conflicting scenarios?
Well, this is a difficult question, but I will try to attempt it. Yes, if you talk about innovation usually, as you rightly said, is for improvement. We want to improve our systems, and to do that, we need to do certain innovations. But those innovations has to be within the policy, within the processes. For example, if you have a good idea, you come up sorting a particular process. You, instead of spending 1 hour, you spend, for example, 20 minutes doing it. We will welcome it, but we are seeing, do we have other side effects of that innovation? So for you to be allowed to implement those things, it has to go through a process. Yes, you have a very good innovative idea. You want to implement it, you test it, you show it somewhere, people have, they want to buy that idea. Now for you to implement it, especially in a mature organization, usually you have to get process before that is accepted and is implemented. So it is difficult for, as you said, in terms of bringing that into play, and at the same time having controls. And now the controls there is by the buying-in of the management. For example, if you have a very innovative thing that will improve controls, you want to implement it. Before you implement it, the controls there is for you to see that, yes, it is addressing what you want, the time is short, and all those things. So for me, innovation, yes, we welcome it, but we want to make sure you do it within policy, within process. It has to be approved. You cannot just have a nice idea of doing certain things, you go and sit in a corner and just implement it like that. We want to make sure that when you have these ideas, bringing them on board before we implement them, they have to be tested. People have to get a sort of a committee that will address that. That's why usually in technology, we have what we call a UAT, user assessment test. We have to check that the way the system is designed, is it going to give us that result, the results that we want? You can have an idea for one particular incident, it happens, it goes as expected. But if you do series of them or you share the idea with some other people, they can see hitches that can even improve it further. So innovation, yes, is welcome, but usually we have to have those controls within it, which means you have to make sure you comply with company policy at all times before implementing those things. There should be a committee that will give you the go-ahead to do it. You cannot just have an idea and come up and do it, but you will encourage the idea, people to be innovative.
Yeah, thank you very much, Mr. Jallow. And I think that's well said there, because organizations can still grow, but there should be a structured way of how you encourage entrepreneurship and innovations. I have seen in some companies where they have what they call lab science. In that lab science, they bring a lot of people from different backgrounds where they can innovate ideas. And they have a committee at the top, maybe the executive committee or a special committee that guides them. When they have ideas, they present it to that committee, they assess it. The committee can be one person. In some organizations, they have what they call sponsors. When you have an idea, you take it to that sponsor who will look at it and support you to ensure management implement it. Therefore, when we are innovating, whatever we are doing, we have to ensure that we are within that framework, because the objective is that there could be a thin line between innovations and the risks you may bring into the organization. They may lose money. In some places, they have a whole research department. And that's why you realize that in accounting, research and development, when you are doing research, the risk is very high. Innovation, very expensive. It's when you reach the development stage where there could be some values based on what you have done, and there's a possibility that it's going to reach to the market, we start accounting it for as an asset. And I think with this now, we'll move to the question and answer session. We have some questions here, and I will start with the director. These questions ask that, should internal audit be part of internal control processes? For instance, should internal audit be part of a payment process, which they are going to audit anyway? Should that be the case? And what is your thought on that, Mr. Ceesay?
Thank you very much, Mr. Sawaneh. And then before I answer that question, just to add on to what you and summarize with Alpha, as to also this element of control being cost effective. I mean, sometimes also we're bogged with controls, but we need to assess whether these controls that we are thinking about as the element of not overstretching us beyond what we need. It's very important that we bring in controls, but we have to also look at the control fit. I mean, how particular control fit. Some organizations, mostly in the public sector, are talking about bringing in a clocking system. For example, you think people are not coming on time and they're not leaving on time. You want to bring in a clocking machine. But really, does the organization needs that control system? Because even if you are input based in your human resource management, in your contribution to the organization, whereas you are paid on monthly basis with or without you doing anything, there are no monitoring systems, there are no operation systems. I mean, if you keep that guy there from 7 to 8 or from 4 to 7 with a device that is just starting to clock in and clock out, I mean, the overall benefit, the organization might not see it. You have a control in place, you've invested in heavy technology over there, you buy a sophisticated and IT system will be set for PUs to clock in and clock out, and then in the end of the day, it may not also lead to corresponding output or benefits to your organization. So that's this element of effectiveness and control. But coming back to your question, should internal audit be involved in this? But the answer is both yes or no. I mean, it depends really on from what angle you're talking about. Really now, the fashion is that internal audit should be staying away. But the self-review thread, looking at the review thread aspect there, which is where the internal audit can review transactions which they somehow take part, and providing the pre-audit, for example, payment vouchers, looking at them before they are passed through. I mean, really, the answer lies in what Bakary and others have mentioned.
His network is hanging there, so maybe we'll come back. He started talking about a very important point there, so I will. So I'll just proceed with Bakary. There is a question which asks that what should be the relationship between internal and external auditors? To what extent, to what level would external auditor rely on the work of an internal auditor?
Good question, Ebrima. So as external auditors, in order for us to actually rely on the work of internal auditors, there are certain things that we would need to be comfortable with. One, we look at the qualifications and experience of those in internal audit. Do they have the right expertise? Do they have the right experience to actually execute their function as internal audit? That's number one. If the internal audit has competent issues, we have people there that are square pegs in round holes. That's a no-go area. We don't even want to look at their reports. We can look at it just for the sake of looking, but we are not going to place any reliance on it. Number two, the other thing that we also look at is, for example, what is the reporting line for internal audit? Is it an organization that internal audit is probably reporting to a CFO, who they are actually supposed to audit? So if you have that kind of skilled reporting line, that actually defeats the purpose of us relying on any work that they have done. Because the reporting line in the first place is wrong, they're not going to produce any report that's going to be of relevance to us. So in that case, also we wouldn't want to even go down to their to actually placing any reliance on their work. However, even if all these things are in place, before we actually rely on their work, we would have also done at least a certain amount of testing. In addition to the work that they have done to support the conclusions that they have done. But we don't just take their reports and place reliance on it without actually performing any work as external auditors, because the box actually stops with us. We are the ones issuing the opinion, and we take full responsibility of whatever opinion that we have given. So whatever conclusion we eventually make has to be based on evidence that we are comfortable with, both in terms of what they have reported and also what we have performed as additional procedures. But I just want to add something that Modou, before he got caught up, said. See, I think Africa, one of our biggest problems is we tend to copy paste a lot. If you want to bring, for example, a timekeeping system, in the West, most organizations have timekeeping system because they are paying their employees on an hourly basis. It is the number of hours that you put in that determines how much money you get at the end of the week or at the end of your 2 week salary period. In our back home, most of our organizations are on salary basis. You're not assessing your employees based on the time that they put in. If you go to accounting firms, yes, they enter time, but that actually even the way we use that time back there and here is different. Here, what happens? I have an engagement letter for $20,000. However, on that engagement, every day the team is charging their time to the engagement. At the end of the day, we are going to look at how much time the team charged to that engagement. If it is $20,000, well and good. If it is above 20,000 that we agreed with the client, and the excess is actually due to delays from the client or inefficiencies that came from the client, we can go back to the client and say, well, we had cost overruns. So we will have discussions with them at that point to bill for overruns. But back home, you have a fixed fee with a client. I haven't seen any client in the Gambia you'll go to after agreeing on $100,000 audit job, and after the engagement, because you have spent more than 100,000, and you say, okay, we're going. They'll say, man, go out to the dustbin. So we can adopt these technologies, we can adapt them, but I like what Modou said, that we should also look at our context. Does it add any value to us? Is it going to be based on how much we are going to pay to our employees before we actually determine to implement those?
Yeah, thank you very much, Bakary. Is Mr. Ceesay back online, Modou?
Mr. Sawaneh, I'm back online.
Okay, you may please proceed. I know you are talking about the payment process
Thank you.
and the perspectives here.
Oh, yes, thank you very much. Sorry for that interruption. Well, I was just trying to advise from the question that came around whether internal audit should be part of these things. Sometimes it depends on what internal audit role. I mean, normally that role is seen. For example, the standard, the IA standards, the standards that guides the from the Institute of Internal Audit, that guides the application of internal audit, would say that if internal audit is given an extra role by management, that may compromise its independence. For example, this role of reviewing, the internal audit should be constantly updating itself about whether that independence is still being jeopardized in terms of that role. For example, here we're talking about building the Chinese walls in terms of those who do those review are the same people, whether who will come and do the post review. Are the pre-audit and the post-audit separated? And also, like I was talking about, also the context of the organization. You look at the control environment of the organization, the maturity in the control environment. I mean, in organizations where but like I would normally say, in most government, this is generally not in government, in government, but most organizations in the public sector, cutting expenditure is not something that that is in there. If an auditor goes to the public sector, to the private sector, where he is looking at the company is unlikely to understate expenditure. That's the risk the auditor is looking at. So Bakary will agree with me that you are looking at, okay, what are the risks around revenue? The risk around revenue is likely overstated. I mean, the opposite happens in the government environment. In the public sector environment, revenue is likely to be understated, and expenditure is likely to be overstated. So you can see the climax of maturity in the governance and the control environment in government, that you have to look at the context and media. Does it add value to attainment of your objectives? If that pre-auditing is adding value, and are there the safeguards in place so that you avoid the self-review threat that is present in you reviewing your own transactions or auditing the transaction that you might have been involved in? So there needs to be that balance in place, and if those safeguards are in place, then fair enough, they can be looked into. But this is a dilemma that people are now focusing more on risk-based and rather than going, pre-auditing is becoming really more archaic, but it's because of the strength of public servants that you have in some cases, or in the organization, the level of control in the management account or the financial accounting is what causes. For me, this is a shift of responsibility. It's like shifting the responsibility of the financial control to the auditor. I mean, really, it's just because the level of control is what causes it. So I'm sure that if that answers the question, thanks.
Yeah, no, thank you very much. It really answers, and that context you've mentioned is very, very important, because the risks in the private sector and the public sector are a bit different. So I'm going to take my last question, and this will go to Mr. Jallow. Mr. Jallow, this one is asking if an organization does not have a board audit committee, in your opinion, what should be the best reporting line of an internal audit function if the organization does not have an audit committee?
Wow, that's a difficult one. Usually, we expect in a mature company that those things will be in place. You have an audit committee, a board audit committee, and where you expect the internal audit head to report. In this case, if you don't have a board audit committee, I think there's a problem. Usually, what small or some organization will do, they will have a small committee, sort of, or they will be reporting directly to the MD in some situations, especially in small organizations where they report directly to the MD. But usually that is not advisable. It is difficult for the auditor to practice as a proper auditor. Your independence you cannot be independent in this case, and even your own performance, because usually internal auditors, our operations are guided by audit plan, and who will approve your audit plan? You have to prepare an audit plan and present it to the board. So if you don't have a board, it means you are just agreeing with your MD areas that you should check. And in an era where we are using risk-based audit, where you want to address the risk of the organization, you need to do a risk assessment. And your risk assessment will now guide you to help you come up with your audit plan. Now, your audit plan needs to be approved. During that process, if you don't have a committee, really you're just going to dance to the tune of the management. And in that case, it will be very difficult for you to function properly, because you will not be effective.
Yeah. Yes. Yeah, no, I agree with you.
Yes. May I just add on that question?
In terms of the internal audit, what Mr. Ceesay was answering. Usually when we are auditing financial statements usually trial balance is made of two balances. It's either a debit or a credit. So the direction of audit usually, it depends on what account items are you looking at. Is it a credit item that you are looking at? For example, revenue. So the risk associated with that is understatement. You are looking for understatement of that revenue. Why do you think there's that risk? Because people might be running away from paying tax. So what you start, your direction of audit in this case, you start from the supporting documents going to the GL. That should be the direction of audit if you are checking for credit balances. If you are checking that of debits, what are you stating? Overstatement of the debits, that's why you're checking. For example, expenses. You want to see whether people are increasing their expenses so that they will reduce their profit so that they pay less tax. So where are you going to start now? You're going to start what is in the GL. What is in the GL, now you marry it to supporting documents. So this is simple direction of testing that I also want to explain, add to your comments. Thank you very much.
Thank you. Mr. Ceesay, you want to add a few words to that?
Yeah, thank you very much. Absolutely, it's very, very right on that. It's just that that norm, sometimes you depart from that norm in a different world altogether, sometimes in the public sector. I just wanted to add in the question relating to the audit committee, lack of audit committee, if there is a board, then the reporting line can be made to the board. I mean, the audit committee, remember, is a subset of the board. So therefore, in instances where you don't have a board at all, which I don't think the questioner may be alluding to, but if there is no audit committee, then the reporting line should be escalated to the board, and the board will play the role of the audit committee. I think the scenarios can be just replicated as such. The board can do the approval of the plan and all whatnot. But it should have been more mature governance when the board created as part of its committees that is recommended in a mature corporate governance environment, for the board to have an audit committee, to have a risk committee, to have a nomination committee, and all other committees that will help it perform its oversight function more effectively. But in instances where you don't have a particular committee in place and the board is there, then the reporting line can be directed to the board. Thank you, to assure the independence.
All right, thank you very much. Once again, good evening, ladies and gentlemen. I think we'll come to the end of this program, but before I end, I want to thank all the panelists, and maybe I will give you 1 or 2 minutes to give us your advice, your word of advice. Mr. Sanneh, let me start with you.
Thank you so much, Ebrima. So I think for me, the key takeaways from all this discussion, and I'm really humbled and honored to participate in this, because both Alpha and Modou brought in different perspectives, and that was very good for our discussion. But some of the key things that I wanted to talk about, like for example, when you talk of controls and you relate it to audit, you have what is called performance or compliance audit. So for example, what Modou is doing could be considered as a performance audit, because you're looking at efficiency and all that. I'll give you an example of what the US government has in place for example, compliance audit or performance audits. So they have what they call compliance supplement. And this compliance supplement looks at, for every organization that the US government is giving money up to $750,000, they expect you to comply with these compliance requirements. And basically, they are almost similar to what we do. Like, for example, they are looking at, for the funds that they're giving you, are you spending them on allowable cost? So they would determine for you what is allowable cost. Allowable cost is any cost that actually goes in helping the organization achieve its objective. Is that funds going into somebody's personal pocket? Then that cost becomes unallowable and you have to take it out. That is, you have to pay back the government. So for every single expenditure that they are doing, they have to make sure that they have support for it and there is genuine business case for it. They look at things like cash management. For example, when you draw the funds from the government portal and you want to use it for something, they're looking at the time period between when you draw those funds and when you spend them. Is the money sitting there for months before you actually spend them? So that alone is a compliance finding. If you withdraw funds today and you spend them 6 months, that's a compliance finding when the auditors come. They look at things like, for example, eligibility. The people that are benefiting from those funds, are they qualified to benefit from them? And a couple of other things. So these are all things that we could also take back home, right? When you're working for an organization that has an overall objective of serving people and not profit making, what is the overall objective? Put in place controls to ensure that the funds are used for their right purpose. The other thing that I also wanted to say, we're talking about importance of controls. Take this back with you. If you're working for an organization that's for profit, your objective is there should be controls that would safeguard the assets of the entity. See, fraud at management level is performed at 2 levels. It's either they misappropriate funds or they manipulate financial results. Put in place controls, whether it is whistleblower controls that Alpha talked about. Have people be able to voice out. And that's why I'm a strong advocate of, for example, internal audit not limiting their work to only processes and procedures within the company, but even looking at the lives of the top executives. If you are making $100,000 a month and you are living a life of $1 million, internal audit should have the power, should be empowered to look at how this person is funding that 900,000 difference. Is it from the organization? And those are my closing points. My dear friends, let's all go back and implement this. And let's all know that control is the business of everybody and not just internal audit or the external auditors. Thank you very much.
Thank you very much, Mr. Sanneh. And that was very helpful feedback and takeaway from today's session. May I ask Mr. Ceesay to please give us his word of advice?
Thank you very much, Mr. Sawaneh. I joined my colleague Bakary. Really, it was a pleasure to be on board. I've missed most of my colleagues here, and for the first time also interacting with great minds like Mr. Sawaneh yourself and Mr. Ba. Really, it's the takeaways that Bakary has mentioned is a very important takeaway. For me, I would really re-echo the point that it's very important that controls are there, but we need to really understand the benefits of those controls and implement them in the way that they will benefit the organizations. Sometimes we just happy that we want to bring in certain controls that are not really applicable or not beneficial to the organization's cost. This is sometimes another concern. On the issue of the Bakary mentioning the internal audit, I think that's a very important point. Internal audit's focus is now should be broadened. I mean, I don't subscribe to those views that the internal audit being an important part of the control element there, like when Bakary was talking about the external audit, reducing reliance, reducing the scope of work, and placing more reliance on the controls. One of the controls there is an effective internal audit. I mean, we must understand that internal audit by itself, the function there is a control element. So that control elements, you should look into how to enhance it, how to make it really stronger. In the public sector, I really subscribe to that view that internal audit should go into areas, not only compliance auditing, the internal audit should move away really from compliance review to focus more on risk-based auditing. I mean, auditing of culture of the organization. The culture of the organization really tackles the issue of the integrity or the tone at the top. The management integrity, which is one of the critical elements of the control environment, I mean, it should be really, really looked at. It should be a fundamental part and parcel of the internal audit program of audit. Because normally, most of the time, we concentrate on the lower level things and forgetting the big things. And where they change, the culture is really where everything really, really boils down to. So it is very important that we part and parcel of the organization's culture and understanding it, and also trying to, test whether it is really being fit and fair. Like he mentioned, a public sector. If your salary in the public sector is able to give you a certain lifestyle, and you see that you are living way beyond that lifestyle. I mean, these are very question marks. These are ethical issues. These are integrity issues. I mean, and those should be put on the board for question. So as we implement controls, we just be cautioned about the cost-benefit analysis of controls and how they benefit the organization, and also look at more controls that would really help us to really alleviate risk and attain our service delivery objectives, whether it's the public sector or it's a private entity. Thank you very much, Mr. Spencer.
All right, thank you very much, Mr. Ceesay. May I move to the birthday man himself, Mr. Jallow, your word of advice as we close today's event? Maybe
thank you. Yes, thank you very much, Sawaneh, and thank you everybody for attending this forum and also giving me the opportunity to be part of this panel. What I would like to emphasize, or the takeaways from here for me today, is to know that the business of control is everybody's business. Every staff of any organization, as far as you are working, you are responsible to contribute to the betterment of that organization. If it is a government organization, government entity, you should also know that you are, in fact, you have more responsibility to ensure that what belongs to the government is enjoyed by everybody. So to do that, I will emphasize that we should be aware of controls, and we should take ownership. At my desk, if I am a teller or anything, I should be responsible for any activity that I'm doing. If you are not sure of doing anything, if you are not sure what will be the outcome, do not do it or reach to somebody else. But you should not allow to be intimidated to do something, and where you lose your job, your family also, it will also affect your family and society. As Sawaneh rightly said at the beginning, where you should see the reason why we have controls in place, part of it is to see whether you have reports on yourself. For example, would you like to see information about yourself on the internet about how you behaved in the past? That will you do something that your grandchildren will be proud of you? Those are the things that you should make sure. Anything you are doing, if you know you cannot sleep, I think I would advise nobody should do that. And I don't know for auditors, internal auditors for that matter, I don't know whether you are aware, but we should be checking on our audit plans. And our audit plans here should be including auditing even the board. Because if you don't check the board, because that is where most of the issues, in fact, problems starts. If your board is not strong, if they don't understand what is happening or how the controls are going, you cannot guide them properly. So you have to check with them in terms of what Bakary was saying, Are they qualified? Did they understand what they are doing? What is their role in terms of that organization? So that way you are also guidance. You should do board assessment as part of your audit always. Culture, it is the message here is at the top. If the tone at the top is strong, obviously it will come down to everybody. But if that one is weak, whatever you do will not succeed. So it is very important that we have a board that has integrity, and you are free. If you think as an internal auditor your board is not, their integrity is questioned, you have every right to resign. Do not be doing business with people who you think and integrity is questionable. With that, I will not associate myself with anyone who is that type. So with that, I think I would like to take this thing, and thank you very much from the end. Thank you very much. Thanks.
Wow, thank you very much, Alpha. That's a very strong closing remarks there. You heard it from him with over 20 years experience in both public, private banking audit, as well as government. And for me, before I give the floor to Mr. Suwa to give his closing remarks, for me, I think we have to remember controls is very key. Every organization, whether it is government or private sector, you are formed for a reason. And anything that can divert you from not achieving the objective of that reason is a major control. Controls is everybody's responsibility. It's not something that is nice to have. It is a need to have thing which all of us should abreast ourselves and participate actively in that. We know that governance, whether it's corporate governance or it's government governance, is a major challenge in Africa. And we can blame the past generations that have gone. But the question that remains for all of us, what do we want to tell or what do we want to leave with the generation that is coming? And it starts with each and every one of us to think that wherever I work, I want to ensure I'm doing the right thing. Because when you do the right thing, you'll be bold to tell somebody else to do the right thing. Mr. Musa Swai, may I please ask you to give a closing remarks and thanks our participants and the panelists for joining us in today's event.
Thank you, Mr. Sawaneh. Great minds indeed. I've enjoyed every bit of the discussion. I think we have even passed the allocated time, but it's worth it. Every minute of it has been a learning point for me, and I'm sure this is true for all the participants here. So first, I will thank you, Sawaneh, for the brilliant job for moderating these important discussions. With the experts, Mr. Ceesay, a director, a senior official, of course. Thank you for your time, your thoughts, and your advice. I'm sure everyone here really appreciate it, and we count on you and everyone in the public service to ensure that we execute our responsibilities for the benefit of every citizen. We thank Mr. Jallow, an African and a Pan-African as well, and also very much familiar with systems across our continent, having spent a lot of time reviewing many operations within Africa. Thanks for your experience. I think this has been insightful. The passion is there. We've seen it. I think we will all want to associate ourselves with your achievement, with your advice, and thank you so much for your time, Mr. Sanneh, all the way from the US. I think the time difference is a lot. Currently, very early in the morning, you're able to wake up, dress up nicely, and join us. I think this is important. Your insights from whatever you're doing, from your time in Gambia to West Africa, now to the US. I think it's valuable. I think it gave us a different perspective, from external audit to how the public relates to the government, relates to the public, or enterprises that are benefiting resources from the government. I think it's important. It's something that we will look hard for, and it's something that we will continue to have discussions across these important areas. I think one key point that we note, and I think it's going to resonate with everyone here. Control is everyone's business, and I think wherever we are, we will not be able to exclude ourselves. Yes, it's the responsibility of the senior management to implement those controls. It is our responsibilities to safeguard the assets of the institutions that is paying our salaries, the institutions that really we also want to build to ensure that, like Ebrima said, the generations to come would have strong institutions. I would not have to deal with the issues that we're dealing with today or the prior generations in terms of weak institutions, weak governance, weak control environments. I think this is very much important. To the participants, I think everyone have dialed in here, close to 40 participants have been active throughout the session. I think this is important. It tells us a lot. I've got participants from New York, participants from Mauritius. I can see people dialing in from Kenya, from Nairobi, people dialing in from Malawi, Zambia. I think this is important. This shows you really, some of them are Gambians, some may not be Gambians, but the interest that we all have as Africans to ensure that we are able to associate ourselves around good governance within the private and to the public institutions as well, and ensure that we are able to strengthen ourselves, we are able to develop a lifestyle that is sustainable, that is within integrity. And Alpha said, all of us are young and are young professionals. Our integrity is something that we need to invest on. Whether someone is looking at us or not, this is what matters. Whatever we do, we should make sure that we are happy for the social media and the internet to publish whatever we are doing across our life, because it's important. This is what we have chosen ourselves to ensure that we maintain and change the Africa that we want, but not the Africa that it's portrayed across the world as weak and non-governable. Thank you so much, and on behalf of the IG Agro Business and Finance, I would thank you for your time, and you should look out for other series coming through. This is a commitment that we will live to, and our doors are open. If you have any suggestions, if you have any contributions, please feel free. Look out for our social media pages. Look out for our emails, our YouTube channels. You can send your comments and give us your feedback. We will take them, and we are happy to interact with anyone to ensure that we develop ourselves, develop our countries, and develop the continent for a better tomorrow. Our Chief Operating Officer had internet issues. On behalf of him, Mr. Salif Uba, thank you so much, and I hope this is an opportunity to encourage our colleagues to invest in a better and a cheaper internet where everyone could have the opportunity to connect virtually with or without the pandemic. Thank you. God bless you all, and God bless everyone. Continue to be safe and take care of yourselves and your families. And thank you once again.